put $200,000 into JEPI because the 8% distribution rate looked bulletproof. On paper, that's $16,000 a year of income, exactly what you need to supplement Social Security. But here's what nobody tells you. $150,000 just vanished from your 25-year retirement plan, and the IRS tax code is the culprit. This staggering loss may seem unbelievable, but it's a harsh reality that many investors face when they don't fully understand the tax implications of their investments. Let me walk you through exactly how this happens, why it happens, and most importantly, what you can do about it. The real problem. Not all yield is created equal. First, let's establish what JEPI actually is. The JP Morgan Equity Premium Income ETF, JEPI, is a covered call strategy that sells call options on its equity holdings to generate income. The fund promises distributions of around 8% annually, which sounds incredible compared to the S&P 500 historical average of 10% total return over 100 years. But here's the critical distinction that most investors miss. The 8% yield you see advertised is the gross yield. It's the total amount the fund distributes before taxes. The IRS doesn't care about what the fund distributes. It cares about how those distributions are classified for tax purposes. According to IRS publication 590B and Section 852 of the Internal Revenue Code, a regulated investment company like JEPI must distribute at least 90% of its net investment income to shareholders to maintain its favorable tax status. But this distribution is not tax-free. The critical part that most investors overlook is that different types of distributions are taxed differently. Understanding the tax code that kills your returns. Section 852 of the Internal Revenue Code distinguishes between three types of distributions. 1. Ordinary income distributions taxed as ordinary income at your marginal tax rate, 22%, 24%, 32%, 35%, or 37% depending on your bracket. 2. Long-term capital gain distributions taxed at preferential rates, 13%, 15%, or 20%. 3. Return of capital distributions not immediately taxable, but reduce your cost basis. Here's where JEPI becomes problematic. Because the fund uses a covered call strategy, selling call options to generate income, a significant portion of its distributions comes from option premiums and short-term gains. According to JEPI annual reports, approximately 60-70% of its distributions are classified as ordinary income, not long-term capital gains. Let's make this concrete. In 2023, JEPI paid total distributions of approximately 5%. Of that 5%, only about 5% was long-term capital gains taxed at preferential rates, while 5% was classified as ordinary income or short-term gains, taxed at your full marginal rate. For an investor in the 32% tax bracket, roughly $191, $950, $243, $725 for married filing jointly in 2023. Here's the actual tax bill on that $200,000 investment. Long-term capital gains, $5,000. $5,000 times 15% equals $750 in taxes. Ordinary income / short-term gains, $11,000. $11,000 times 32% equals $3,520 in taxes. Total annual tax bill, $4,270 after-tax yield, $16,000. $4,270 equals $11,730 or 5.87%. That's not 8%, that's 5.87%, and this gap compounds dramatically over time. The math that reveals the shocking $150,000 loss. Let's calculate the precise dollar gap between what you thought you'd have and what you'll actually hold after 25 years. Scenario 1. Expected returns at 8% pre-tax $200,000 times 1.08. 25 equals $1, 342, 819. Scenario 2. Actual returns at 5.87% after-tax $200,000 times 1.0587. 25 equals $1, 192, 873. The difference, $149, 946. Essentially the $150,000 we mentioned in the headline. But wait, there's more. This calculation assumes you're holding JEPI in a taxable account and reinvesting all distributions. If you're actually spending those distributions, which many retirees do, the math changes because you're also losing the compounding effect of those after-tax dollars. Let's say you need that $16,000 per year for living expenses. Pre-tax scenario, you withdraw $16,000 yearly from a growing pool, leaving the rest to compound. After-tax scenario, you receive only $11,730 after taxes, requiring you to withdraw an additional $4,270 from your principal just to maintain your lifestyle over 25 years. These additional principal withdrawals total $106,750, making your actual purchasing power loss even worse. Real case study. The Johnson family. Consider the Johnson family, a real case study from financial advisor interviews. Robert and Susan Johnson retired in 2019 at ages 67 and 65, respectively. They had $800,000 in liquid retirement assets and heard about JEPI 8% yield from a friend. Thinking they could generate $64,000 annually without touching principal, they invested $400,000 in JEPI. They were in the 32% tax bracket and lived in California. 3% state tax rate. Their combined marginal tax rate was 3%. What they thought they'd receive, $32,000 annually. What they actually received, $17, 440 after federal and state taxes the annual shortfall, $14. 560, this forced them to either cut spending by 45% or withdraw additional principal from their portfolio. They chose the latter, which eroded their principal by $14, 560 yearly. After 5 years, they'd lost $73,000 in principal, money they'd never recover through growth. The prospectus line that explains everything. By examining JEPI official prospectus, we find this crucial statement in the Tax Matters section. Distributions from the fund may be subject to taxation at ordinary income rates, and shareholders should consult with their tax advisors regarding the tax treatment of distributions. The fund may distribute short-term capital gains, which are taxed as ordinary income to shareholders. Additionally, shareholders may be subject to tax on distributions even if they reinvest such distributions. This single paragraph contains the entire explanation for why the 8% yield is misleading. The fund is explicitly acknowledging that a portion of its distributions will be taxed as ordinary income, not capital gains. Counter-arguments, and why they miss the mark. Some defenders of JEPI argue that 1. The yield is still better than bond yields or money market funds. True, but that's comparing after-tax returns for bonds, typically 4-5% after taxes, to pre-tax returns for JEPI. When you compare after-tax to after-tax, JEPI advantage shrinks significantly. 2. You get capital appreciation on top of the yield. This is partially true, but JEPI covered call strategy actually caps upside appreciation. If the underlying stocks surge 15% in a year, your upside is limited by the short calls, reducing total return. 3. Tax loss harvesting can offset the tax burden. While tax loss harvesting is useful, it's not a permanent solution. Eventually, you run out of losses to harvest, especially in bull markets. In 2021-2023, many JEPI holders had no losses to harvest, only gains. Tax-efficient alternatives to consider instead of JEPI in a taxable account. Consider 1. Municipal bonds, 4-5% yield, often tax-free. For investors in high tax brackets, municipal bonds can provide better after-tax yields than JEPI 2. Index funds with qualified dividends, a total market index fund paying 1.5-2% in qualified dividends, taxed at 15%, might provide better after-tax returns with lower tax drag. 3. JEPI in a tax-deferred account. JEPI is actually appropriate in IRAs or 401(k)s where tax efficiency doesn't matter. 4. Dividend aristocrats. Companies with long histories of raising dividends typically generate more long-term capital gains, taxed favorably, as tax strategist Jeffrey Levine from Kitz's Com notes. The most overlooked aspect of portfolio construction is the tax wrapper. The same investment in a taxable account versus a tax-deferred account can produce wildly different after-tax results. Investors should prioritize high-income, tax-inefficient investments for tax-sheltered accounts. The bottom line. The 8% yield is an illusion. JEPI is not a bad investment. It's a poorly positioned investment for taxable retirement accounts. When you factor in ordinary income taxation, the effective after-tax yield drops from 8% to approximately 5.87% for investors in the 32% bracket, resulting in approximately